And we're live. Happy Wednesday, everyone, and welcome to the Mojo Show, your real estate podcast where we talk everything real estate. I'm your host, Joe Mortgage.
And I'm Cup of Joe Mortgage.
This week's episode, we are continuing on with our 6-part series on decoding mortgage programs. This is episode 4, actually, of that 6-part series. This week's episode, we are focusing on mortgage programs for investment properties. Super excited about this show today. But before we get to that, Joe, our coffee talk that we have every show at this time, I want to actually, before we actually get into the topic that's want to talk about for a coffee talk, I want to open this up because it's always been you and me talking about this, right? I want to open this up to our listening audience so that we can kind of have a coffee talk with you as well. Right. So those of you that are listening in, feel free to drop your comments on this because this weekend is Father's Day weekend. A great time to honor those that are dads out there, especially you, Joe. I know with your 2 children, your son and daughter, I know you're a great dad in what you do. You just have that leadership style, that servant leadership style about you that I know you're a great dad. So this is going to be, are the kids planning anything for you this weekend?
You know, we've been that type of family. We don't do extravagant plans and things like that. So this weekend, it's just about spending time together. And my kids mean everything to me. And so does my family. So we're just going to spend it in the backyard at the pool. We're gonna probably just cook hamburgers, hot dogs, and just chill and watch some TV while we're just hanging out in the pool together. We'll have the wife's dad and mom over and just chill. So I like that more than anything. A lot of times we'll go to the lake, but boats and they're never working right. So we're gonna just spend it at the house. What are you doing? You got your daughter. She's living at home right now, right?
Yeah, she's home from college. Yep, she's home from college. So I don't know if she'll, remember this Father's Day. We'll find out, I guess. Let me ask this, though, Joe. Your dad, because he's up in Kansas City still,
right outside of Kansas City in Missouri. Yeah.
So let me ask you, and I want to ask the listeners as well, if you would drop your comments below. Joel, for you, what is your favorite memory with you and your dad together?
Oh, man, there's so many of them. But I would say my favorite memory with my dad is when I was growing up, we'd go fishing. We lived down south of Houston in a town called Pearland for a long time. And we would go out to, I think it's Chocolate Bay or Cocoa Bay or something like that. My dad had a contractor that, he worked at Sears and home improvement. So he had a contractor that had a big kind of a boat out there on a slip. And we would go fishing on Friday night or a Saturday night. And then we would drive back. And I just remember we'd go out there and we'd fish and just hang out. And his friend would cook the fish, speckled trout. If you haven't had it, it's fantastic fish to eat. But we would go out there and that was just the memories. I mean, we never spent a ton of money on vacations, but the best memories I have is doing that or woodworking in the garage with my dad. That's where I got all my skills, different things. We'd make hope chests. We'd make little things, knickknacks. But woodworking was something that it was his stress reliever. He wasn't a sports guy. I mean, we played a ton of sports, but he wasn't a sports guy. So I learned a lot of my other skills and trades from him. So that was those were the great memories from my dad. But with you, what's something, I know your dad's, you've been gone for about 15 years now, you said. Hate to hear that, but when we get older, every day is precious. But what is the favorite memory of yours for your dad?
Golfing, dad, playing golf with dad, and that definitely was. And I still remember the day that we were playing and I knew I beat him. I knew I did. And we get to the 18th hole, right? We get to the 18th hole and I was up 2 strokes. And I'm, out of me and my 2 older brothers, I was the only one so far that didn't beat dad. And this round, I was going to beat him. And I ended up purposely shanking it.
Yep.
And he ended up winning that, by one stroke. I did not, I already knew I beat him, right? So what was the point, right? But I wanted him to make sure he had that pride of always being able to at least beat me. Right?
Well, I'm going to give you credit on that one, because I can tell you right now, my son will not do that.
Yeah.
He's already in those pushing matches with me. I've given up now, because he's taller than I am. He weighs about the same as I do now, and he's a heck of a lot stronger than I am. And so I gave up on pushing him until that one day you come home, you maybe had a couple of social drinks with your friends, and you come home thinking you're the old man still strength, and he puts me on the ground. So that was the last time I'm going to get in a shoving match with my son. So
well, we could talk all day about our dads and being dads, but we definitely want to jump, because there's so much information that we got to cover today, and I'm super excited about this program, especially about investment properties and types of mortgages to be able, especially the guests that we have on today.
Yes.
I'm super excited to have her on. She's a loan officer with UMortgage who specializes in self-employed borrowers. She was actually named Rising Star of 2023 by NXT Mortgage. She's a real estate investor herself who built $1 million portfolio using the BRRRR method. If you've ever heard of the BRRRR method, please welcome to the show, Ashley Henderson, everyone.
Hey guys, thanks for having me.
We are excited to have you here. And I know that, we get questions all the time about investment financing and building a portfolio. So this is going to be a great show having you on. But before we get into that, if you are listening, we need questions. Ashley is here to answer your questions. I don't care if you think it's a dumb question or anything like that. Questions that, you have are not dumb. Nobody knows everything about this. That's why we bring specialists on. I've been in lending for 23 years, and Ashley's been in it for a lot less. I'm not going to say the time, but but she knows these products and she knows how to do it, and that's why we're excited to have you on. So if you have questions, please drop it in there. We will ask Ashley. She's going to be seeing them too. But Ashley, before we get into kind of today's topic, tell our viewers about yourself.
Yeah, so I actually started my career on the banking side, which a lot of people don't know about. So when I actually started as a business banker for Citizens Bank in my local hometown. So that was very nice to work with local business owners and really get my feet wet in the finance industry. And then I actually switched and went to operations, and I worked for PNC Bank. And I did process improvement. So that's where my background comes with being obsessed with the process and the customer experience. I'm Lean Six Sigma certified. So, that's something that's very important to me. So I love UMortgage that we really take a lot of pride in our process. And I get really into that and really nerdy in that, because that was a background that I had. And then after that, I actually got into marketing. So on the sales side. So I've really had a diverse background of finance and marketing. And when I was doing marketing, I was working in Dallas, and then we had offices in Fort Worth. And I was driving to work and listening to podcasts. And I quickly realized that real estate was the best path to wealth. So reading a lot of books, listening to podcasts like yours, getting on YouTube, and just being self-taught and educated. And I started investing in real estate in 2018. And that really jump-started my journey into real estate. And then, after a while, I really decided, hey, I want to do this and help others be able to grow their wealth through real estate. And I love the numbers, love the finance, love the analysis and the pre-underwrite for my portfolio. So I wanted to bring that to the table for my local market back home in Pennsylvania. And then, my local market here in Texas, and help, everyday Americans grow their wealth through real estate because it really is the best tool. You want to augment it with some others. I also enjoy investing in the stock market, but real estate truly is the best wealth tool. And I love to be able to share that, with everybody every day. And I get to do that now. So that's really what got me to this point.
Okay. Well, that's awesome. So when you're going, to talk to either, people that are looking to buy or just, talking with realtors that are looking to what kind of products we have, let's start with the most, simple or common products that our buyers can get out there. Kind of tell us which ones from an investment property lending are the most common, like your conventional type loans. Tell us about those.
Yeah, so most people are going to fall into that conventional investment loan bucket. And I work with a range of investors from, this is my first time, this is my first investment property, to, this is a 12-unit, property, and it's, a portfolio loan and very complex, and they're, very savvy investors. But most people are going to fall in that conventional bucket. And the reason is, there's many benefits to it. It's the simplest of all of the options. And most people, have a salary or they're paid hourly and their income supports that product. We can get into other products for other folks who don't fall into that bucket, but there's a lot of benefits to that conventional investment product that people really enjoy and can benefit from. And one of those is not having a prepayment penalty. So when you choose an investment product like a conventional, that's a huge benefit. And not only are you going to not have a prepayment penalty, you're also going to have slightly better, not as much as it used to be, interest rate, and slightly better on the cost as well. So if we can fit people into that bucket, if it makes sense for what they're trying to achieve with that specific property, we're always going to look there first because that's the best route. And then if it doesn't fit, then we have plenty of options as a broker to really help them find the best fit to help them achieve their goal for that particular property.
Yeah.
Nice.
Well, during this series, Joe and I, we've talked about down payments and as low as whatever. It's a little different in the investment purchase, when you're doing an investment purchase, especially on conventional. Kind of tell people that are listening what they need to prepare for out of pocket, the down payment part, the percentage when it comes to conventional, because we'll get into other ones as we're talking today. But let's start there. What is kind of that down payment range? The minimum, talk about that because everybody wants the minimum down, but
Absolutely.
the disadvantages to the minimum down, and kind of where's that sweet spot when it comes to investment purchases on conventional.
Yeah. So conventional specifically, the minimum down payment is going to be 20%. However, you kind of alluded to what that comes with that. So, 20% is the minimum. That's kind of like the barrier to entry. But with that, the client is going to have slightly higher fees, so discount points. So really that sweet spot is 25% down or more. Now that is a significant down payment, but if it's a turnkey property, meaning they're maybe just very light rehab, very little that the investor needs to do to get that property up and running, it's still the best product. And it's a great fit. You have a lot of equity, but the barrier to entry is high, as it is with most investment properties. But we do have some things we can talk about to help people break into real estate investing if they don't have 20 to 25% down.
Yep. And I know you're going to be talking about that one here in a little bit because there are ways of doing that. And but when it comes to the conventional finance, you said it right. There is no prepayment penalty. They've done away with those. I mean, I've been in lending for 23 years. We had prepayment penalties on everything back then, and then with the regulations and changes. The benefit of a conventional, in my opinion, to do it for your investments, it is when the market drops. If rates do go down, you're never going to be in the same realm as a primary home, but it is a way of refinancing to drop so you can hopefully increase your cash flow. So that's one thing. Tell me if I'm wrong on this one. This is what I told you yesterday. I'm going to go off script, but tell me if I'm wrong on this one. When it comes to buying investment properties, cash flow is good, but you're not going to be making a ton of money off that cash flow in the very beginning. It's going to be more of a cash flow later on in your life, more towards your retirement time or when you sell a property. Because right now you're basically just trying to get somebody else to rent it to pay that mortgage payment to build your wealth and your equity. Is that correct in that mindset? Don't think, hey, I've got a cash flow $500 a month to try to offset some bills.
That's correct. And I think that's a very big misconception, either of beginner real estate investors or folks that don't have any care to get into real estate investing. If you tell them, my goal is to make $100 to $200 cash flow, and cash flow means after all expenses are paid, you have X amount of dollars left over. That's your cash flow. Mm-hmm. So when you tell that to somebody and you say, well, my goal is to make 100 to 200, which is realistic, they kind of look at you funny, right? Because you're putting all this time into educating, and it's a stressful process. It's a lot of money. And you're like, you're only going to make $100 to $200 a month. And yes, now, right, we might make $100 to $200 a month per door, meaning if it's a multi-unit, you make that per unit. Mm-hmm. But down the road, when that loan is paid off, that, like you said, Joe, is your retirement. That's a wonderful source of retirement income, and it's passive. Now, it's not 100% passive, especially if you are managing the property yourself. But going to work every day as a 9 to 5, clocking in and out, it is much more passive than that, and that's a great retirement option for all of us.
Mm-hmm. Yeah. Joe, it looks like we have a first question of the day from Eric. If you want to show that up there.
Yeah.
I don't know anything about this, so hopefully Ashley does.
So evidently there's a welcome home grant to assist with down payment. Is this real? I don't know if you've heard of this at all, Ashley. What are your thoughts?
So I haven't heard of the welcome home grant specifically, but I have helped a client purchase a investment property using down payment assistance. And it sounds like this welcome home grant is probably similar. There's many programs out there, which is wonderful. So it sounds like this is one of those programs. So I hope this answers your question, Eric. But yes, we can use a grant or down payment assistance if you plan to occupy the property. So I can't speak specifically to the welcome home grant. I would think, in my experience, and Joe's, you can comment on this too. Typically, if it's a grant, they do want you to occupy the property, meaning that it's owner occupied. So you can still have an investment if there's an ADU, an accessory dwelling unit in the back or on the property somewhere, or maybe it's a 2-unit or 3-unit, that's possible. But most of the time, the lender or the holder of that program is going to require you to occupy that property, if that makes sense.
Most grant, oh, sorry, Joe.
No, go ahead. Go ahead, Joe.
Most grant or city reinvestment acts and things like that, Eric, just so you know, they are based on rebuilding certain areas, lower income areas, maybe, crime areas that they're trying to revamp and bring people in. They are not wanting to put that money out for investors because they feel like that's just going to keep the same repetitive kind of things going on in that area. I know Section 8 housing, they will give certain money for rentals and stuff like that in certain areas. So, that might be one, Eric, that you would maybe, call Joe or I or Ashley, and we can look into where you're wanting to buy, and we can try to find out in certain areas. But I know like City of Fort Worth, they're really trying to get the downtown, South downtown area really going. So it's more about, bringing in people that want to live there because they're trying to change the culture of the area too, which is a good thing when it comes to that. And hey, we've got another one, Joe, and this one is my family member. This is my nephew, married my niece. And this is, I'm glad he's on here because Jacob and Shelby, they just bought their first house, Ashley. I just did their purchase up in Nebraska, but they are looking to get into the investments. They're younger, kind of like yourself. They're wanting to build a portfolio of wealth. So let's go with his question here. So that way you can, help him understand it too.
Yeah. So it's a great question, Jacob. At the beginning, when you're analyzing the deal, you're always analyzing for today, right? And everybody's goals are a little different. Some people buy for appreciation, especially like in the Texas market, we have great appreciation. In the Pennsylvania market, you're buying a little bit more on the cash flow side. Appreciation is a benefit, but cash flow is going to be more of your niche there. So to answer your question, yes, you want to account for rent increases over time because you will get those every single year, and you have to get those every single year because unfortunately your insurance goes up every year, your home insurance, and your property taxes go up every year, and then maintenance and things like that. So yes, you want to analyze for today's numbers, and then there's a really cool tool that we'll have to figure out how to share, but there's a tool, it's called Deal Check, and it's free. And it's free, up to so many, rental properties or things like that. But it allows you to look at that property, and then over time, it's actually going to do those increases for you. And you just put in the percentage, 5%, 3.5%, 4%, whatever it might be, for your rent increases, and it will show you that forecast into the future. So yes, you want to look down the road, absolutely, but focus on today, now, and those numbers first. Instead of down the road, look at down the road as a bonus because it is going to be much better down the road. Make sure today that property fits your criteria today so that you're not uncomfortable or not hitting your goals. And then down the road, you'll get that, rent increases over time as a bonus.
So just to try to help out there, I just Googled real quick Deal Check, and this is what I got. So wanted to pop it down there in the bottom. Hopefully that's a help for you to be able to research as far as what Ashley's talking about. I have a question for you. I mean, we've jumped around a little bit, but want to get back to as far as the mortgages. Thanks, Joe, for that again, as you usually do.
Hey, we got people talking to us.
Great questions, too.
I always try to time him, and this time it took just over 15 minutes for him to divert and go sideways on us. So
hey, we're going to be well over 30 minutes today. So, all of our viewers and listeners, we're going to go over time because this is important. So.
This is so much great information, no doubt about it. So, Ashley, we talked about conventional loans, right, for investment properties, but there, besides just a standard conventional loan, what's more of a typical type of loan mortgage that you would use for an investment property?
So as you continue to maybe develop your portfolio and you have multiple properties, and either you decide to leave your W-2 job and just focus on your portfolio and being a full-time investor, or maybe you still have a W-2, but as you continue to grow your portfolio, what happens is certain lenders will start to cut you off from a standpoint of how many loans you can have in your personal name. And this happens a lot. I actually get a lot of business from this because, people max out on loans in their personal name for real estate. Mm-hmm. And they come to me and they say, Ashley, do you have a max? Can we continue to do this? And the great answer is yes, we can. As a broker, we have access to plenty of lenders who don't care how many properties you have. And we focus specifically on the subject property, the property that you're either looking to purchase or refinance. So to answer your question, I'm leading into one of my favorite products, which is a debt service coverage ratio loan. It's commonly called DSCR, and it's thrown around a lot in the investor world, as it should be. If you're not familiar with this loan and you want to get into real estate, or you already are in real estate, this is something you need to know about. It's a fantastic product that focuses on the property itself for qualifying more than the individual. So what I mean by that is, if the property is profitable, and it's a very simple equation that we can all do. I do it for my clients, but I educate them on how they can run it as well in their pre-analysis, is we take the gross rent for the month and we divide it by the principal, interest, taxes, and insurance. And if that number comes out to 1 or higher, you have a property that is sufficient to qualify for a loan and then also possibly be profitable. So we like to see a 1 or higher. And a simple math example of that, because I like to keep things simple, is if your gross rent was $1,000 a month and your principal, interest, taxes, and insurance and any HOA dues was $1,000 a month, that's a 1% DSCR ratio. And that means you would qualify for the loan. Now, the only thing we look at from an individual standpoint is we want to see that you are a responsible borrower. So we look at your FICO score. So it is still very important, no matter if you're using, an investor loan like this, which is considered kind of a business purpose loan, or you're sticking with conventional, you have to take care of your credit score. Most investors do, which is great, and we should. Because if you don't, you are doing yourself a disservice, because you will get a higher interest rate, you will have higher fees. So do yourself a favor, take care of your credit score and get everything that's available to you. You want to be able to max out, getting the best rate, the best terms, and having a great credit score is a way to do that. So the only thing we look at on the DSCR ratio from an individual perspective is the individual's FICO score, so their credit score. Everything else is based on the property's performance as a business.
So this is great, because I love it, because it's not looking at your personal income. It's really looking at the income of the property.
That's
right?
correct. Yeah, and it's really cool because investors that really want to take that leap and become a full-time investor, and it's not for everybody, but there are a lot of people that do that, this is the product for them. Because we actually don't care if you are employed or not. We don't care, if you give us tax returns. We actually don't want your tax returns. We don't want pay stubs. So it's a lower document loan. You also have the ability to close in an LLC, or a trust. Nice. Most people like to close in an LLC. That's what I do personally as well. And everyone's different, but I always kind of mention that is, an added bonus, because if you go conventional, unfortunately, we can't close in an LLC. So you have to close in your personal name. But, when we go to these investor products, they really are built for the investor, and you can close in an LLC should you want to.
Especially if you're using like yourself. I know you are a fan of the BRRRR method. Right, which those of you that are listening in, if you're not familiar with the BRRRR, Ashley, go ahead, if you would, explain the BRRRR method real quick for us.
Yeah, so what the BRRRR method is, and it's quite complex from a kind of fundamental standpoint, but the more that you read about it, the more you educate yourself on it, the more it starts to click and make sense. So to introduce it to you, the acronym stands for buy, rehab, rent, refinance, and then you're going to repeat the process.
Yep, there you go.
So the beauty of this strategy is that you use the same funds over and over and over again. And I really gravitated to this strategy because I found out very quickly on my first property that money doesn't grow on trees, and that once you put 20 to 25% into a property, it's stuck in there, and you can't continue to grow at a fast pace should you want to do that. So for me, the BRRRR method was a great strategy that allowed me to use the same funds over and over again to grow my portfolio. And I do this with a lot of my investors. Some are aware of it, some are not, but I think it's becoming more and more popular. And some people say, well, is that legal? Is that work? And yes, it absolutely is. And I've done it and built my portfolio through it. And I'm happy to help my clients do the same.
Yeah.
Right.
Well, and Joe, we've got another question here, actually.
Yep.
Actually, a couple of questions now are starting to pop in here. So, this is good. This is great.
I saw the AD. Are there any down payment assistance programs for DSCRs? There's not. To be just straightforward, there could be some things out there, but nothing. Like we were saying earlier, there's no true down payment assistance for investment purchases. So one of the things that I would say, if you're trying to find a way of getting the money, okay, and we're going to get into that on the next topic. I know there's ways that we're going to talk about how you can start building your portfolio. But let's say you already own your house and you have equity in it. You could look at doing a line of credit. If you don't want to touch that first mortgage, a lot of us have 3% or low 4% or high 2% on our first mortgages. You don't want to touch that if you don't have to. So you could do a line of credit on your house, on your current property, to get the money for the down payments. That's an option. Another option would be 401k loan, and then you can pay yourself back, especially if you're doing a DSCR, because we're not taking any of that into account. And a 401k loan doesn't go into debt ratio calculations anyways. But pull money out that you've already put into your 401k and invest into this, and then you're just paying yourself back on a monthly basis. So you're building your wealth both ways. Those would be the easy ones, to where you're not having to figure out where do I get the money from, because somebody's not just going to give you money to start building your wealth. You're going to have to either have it in your 401k where you can pull it out there, or equity in the house that you already live in. And I know we could talk about DSCRs, right? Yeah, DSCR loans all day long. And Ashley, actually, I have a client that I'm going to be getting with you so we can go through it. But the nice thing about it is you got to find the money somewhere else on those products, but it doesn't take into account your personal debt. And that's the nice thing about building wealth too with that product. But on that product too, and I know Ashley, you'd say this, you have prepayment options. If you try to go with no prepayment penalty, those rates are going to be really high. Your cash flow is going to really hurt. So you got to understand they're going to put a prepayment penalty on there. There's different ways of doing it. So make sure you're talking to a great loan originator that deals with them, so they can explain to you prepayment penalties, because everybody thinks prepayment penalties are bad. They're not always bad. It's also to help us get rates down to where you can cash flow on a DSCR. So you just got to understand why they're there. And nice thing is you can write off all the mortgage interest you have against your rents. So you're not having to pay taxes on that money either. Right. So, everybody needs to understand that there are little things on those. But, I know we're going over time, so I want to get to the next, really the hacking, right? I say it that way, but I'm going to let you explain what that is.
Housing hack.
The housing hack, to help people understand, how can I build my wealth, but I don't even own a home yet?
Yeah, so it's a great segue from the last question that we had. A lot of the times, that 20 to 25% down payment is a big hurdle, right? Real estate continues to go up. The prices continue to go up, and saving 20 to 25%, you can't do that overnight. So how do we break into real estate investing with less money? So you have to be willing to make a sacrifice, which is everything in life. So what we can do is we can actually utilize the strategy of house hacking. And what that is you occupy, so it's owner occupied, part of the investment property, whether it is you occupy one of 4 units or one of 2 units, whether you occupy a portion of the property, so 1 bedroom versus, other bedrooms, or like we mentioned earlier, an accessory dwelling unit, an ADU. So if you occupy one of those units and a tenant occupies the other, it's called house hacking. And the beauty of that is that you lower your living expenses significantly, or you can actually break even or make a profit. So typically the goal is to lower the expenses and to break even, but you can actually make a profit doing that as well. And that is part of the house hacking process. But the other part that's really great is you can break into those programs using less money down. So we can utilize a conventional loan and put 5% down for 1 to 4 units. Or we can go FHA if that's a better fit for you and your credit score. And we can do 3.5% down. So
nice.
That's a huge difference from 20 to 25%. Now, like I said, you have to be willing to sacrifice maybe some of your personal space. It's very popular with younger people, people in their 20s, 30s. But I have had people, in their 50s who were open to this strategy as well. 60s, they whether maybe they want to have somebody buy, or maybe they just want to lower their expenses. If you're okay with this and your family situation is okay with this, this is one of the best strategies, because after you do this in a year or two, you can go do this again somewhere else. So it's an amazing strategy to grow your wealth, to break into real estate, and to do it for the least amount of money down as possible. This is the way to do that. Otherwise, you're paying 15% or more.
Well, and another one that you didn't touch on is empty nesters. If you have kids going off to college, the first year they live in dorms, but the second year they start looking at apartments or whatever. This could be where if you get them credit, a little bit of credit, they don't have to have income, but you could actually do a primary purchase with them being the primary, one living in the house. You could be a non-occupant co-signer with your income, and you could still do the same thing. We did it for my brother. They did a 5% down purchase, conventional, for my nephew that was going to Nebraska, University of Nebraska there in Lincoln. And they got into an investment home with very little down because my nephew was the primary. Well, what they're doing is over time they're collecting the rent, but they can always refinance and take my nephew off later if he had nothing to do with it. Or it could be a great college gift when your kid graduates. Give them that rental property. Let them start building their wealth. So that's another one that is a very good way of doing it. And it's amazing on not enough people think of it that way. And having a rental in a college town, you always have people renting.
Always. Yeah.
Absolutely.
Yes,
So,
absolutely.
But we did have another question real quick, Joe. I know we're over time, but we have another one. Jacob, again, how much of the rehab portion do you do personally versus hiring a contractor? I have remodeled a bunch of houses. I think it's going to, in my opinion, and I'll let Ashley talk because she's done this too, is it depends on what your skill set is. And it also depends on your time. If you're working a full-time job and you're just getting into it, hiring a contractor is one of those sacrifices that I would say you might want to do to make sure it gets done in a timely manner and less cost. And you learn from that contractor. So if you want to take it over down the road, that's something you can do. But if you have the time and you're in a trade, like my other nephew is becoming a journeyman plumber, and if he has the time and he has the skill set, then he could probably do it different. But Ashley, what is your take on that?
Yeah, I think that's a great response. Jacob, it really depends on your goals as well. Joe was right about everything that he said. I personally, I'm not skilled in the trade, so I hired a contractor for all of my rehabs. But like Joe said, the time, it really matters, especially, if you're doing a hard money loan up front and you're paying interest. Not only your time requirement, but the time you take to flip it, right? So in the BRRRR method or not in the BRRRR method, you still want to get that property live as soon as possible, because every moment that it is not rented, you're paying for that.
Yeah.
So you want it to start generating income as soon as possible. And having a contractor, having different tradespeople come in to do what they do best is going to really speed up that turn time if you are taking on a rehab. So I personally like to utilize a contractor that I trust, and they do a fantastic job. I pay for what I get, so I get a good product. But I believe in that because, this is a long-term play. We want it to last. So that's a whole nother conversation about materials and things like that you use. But it's a great question, and it really depends on you specifically in your situation. But what Joe said and, kind of what I commented is kind of a great rule of thumb. And then just decide for you, and you're going to make decisions in your real estate portfolio that you're going to change. So you're going to try something, and then you're like, yeah, I really don't want to, fix this toilet or manage my property or whatever it may be. And you're just going to pivot and adapt. So just get out there and do it and try it, and then, grow and continuously improve over time.
Well, I know
we're going to have Ashley on here again.
We are
too good.
This is such a hot topic right now. It really is. And I just have one more question. If we could just touch on, briefly or as in depth as you want to go, Ashley. But last week we had Armando from Angel Oak on talking about bank statement loans. Now, am I correct to understand this could also be used for investment properties?
Yes. Bank statement loans is again, one of my favorite products. A bank statement loan, if you're not familiar with it, is for self-employed individuals. So you unfortunately can't utilize a bank statement loan if you're a W-2 employee, unless your spouse or somebody, that you're on the loan with is a self-employed borrower. So if you're a business owner, if you're a 1099, you can utilize a bank statement loan, which is something that we all do, Joe and both Joe's and myself. And we can take bank statements to actually calculate your income. So rather than using tax returns where, you're writing a lot off, which, I understand, we can use bank statements 12 to 24 months, and we're going to calculate your income based on those. And sometimes a bank statement loan has slightly better interest rates. So to put into a real life story, I worked with one of my clients who was an anesthesiologist, and he had recently shifted, to having his own business and, to then just actually charging back, for his services. And we have utilized a DSCR loan in the past. And we were looking for a way to kind of save and get a little bit better interest rate. So we explored the bank statements because he's technically self-employed. We were able to save him some cost on the rate. And then we were also able to get him a little bit, better interest rate for that cost. And it worked out really well. So it's another way that we can pivot to find, best kind of maximize your purchase experience based on your goals, your situation that's unique to you. But yes, you can absolutely use a bank statement loan to purchase an investment property.
Sweet. That is cool. That is so cool. Well, I know we're going over, but I want to thank Ashley for, coming on. Joe and I so appreciate you coming on the show today and giving your insights. Especially to all of our listeners. We're definitely going to have you back on. If we can twist your arm to do it again, we'd love it. Because I think this is a hot topic for everyone and that. So if you have any questions though for Ashley, or you want to get a hold of her to discuss further, you can definitely get a hold of her. You can see along the bottom there, her phone number and her Instagram account as well. So you can hit her up on that to be able to chat with her further. Next week, we are putting a slight pause on our series, Decoding Mortgage Programs, as Joe and I are heading up to Michigan for a 2-day conference next week. But no worries, we'll be back the following week, picking up our series on decoding mortgage programs. And we're going to be focusing that next episode on new construction homes. I think another great hot topic right now for a lot of people, what mortgages to use for new home construction, different programs for that. So be sure to tune in 2 weeks from now at our usual time, Wednesday, 9 a.m. Central Standard Time. Thank you, everyone, for tuning in. All of your questions, we really appreciate it. This has been a great show. If you want to catch up on any of our past episodes, especially as we go through this series, Decoding Mortgage Programs, you can always go to our YouTube channel at the Mojo Show Real Estate Podcast. And while you're there, be sure to hit the subscribe button because we are on a mission to get to 1,000 subscribers. So be sure and hit that subscribe button. Before we close it out, Joe, any last words?
Thank you guys for tuning in, and thank you, Joe and Ashley, for everything to support my, off topics all the time.
It was a pleasure. Thank you guys for having me.
Well, I'm Joe Mortgage, and that handsome guy there with the beard on is Cup of Joe Mortgage, and we'll see you next week.
Mr.